Hey, what's going on, everybody? It is Friday, April 8th. A little bit of a disappointing close. I'd say disappointing close in the market today. Dow was up. S&P was up for a while. It came off its lows. NASDAQ tried to make a comeback, but it closed kind of weak. So we're still struggling with this, the interest rate fears and Fed policy fears. And that's probably going to continue like this kind of choppy market action with a downside bias all the way into the Fed meeting, which I believe is May 8th. So just be aware that, you know, this is probably going to be the kind of trading environment we're in until we get the Fed's action, its policy action on May 8th, and, you know, where it spells everything out. But I still believe that a lot of what the Fed is expected to do over the course of this year and maybe early into next year, it's already reflected in interest rates. This has been, you know, I've been in this business a long time. I mean, this has been the most telegraphed policy move, and I'm talking about policy move over an extended period of time. This is the most telegraphed move that I can recall. So, I mean, you see where the 10-year yield is, you see where bond yields are. It is totally pricing in, you know, whatever, 9 rate hikes or however aggressive the Fed is going to be. And that's still a question mark. You know, again, not to sound repetitive, I know I've been saying this over and over again, but I'm kind of looking forward to it, and I want to see how this plays out. Nobody else is talking about the issue that I raised, that being the Fed as they pay interest on reserves and it comes out of their profits, and just how high can they go before they don't have any positive cash flow. And we're gonna see. You know, I could be completely wrong on that, but remember, prior to 2008, the Treasury paid interest on reserves, and that wasn't a problem. The Treasury has the power of the purse. As long as Congress appropriates it, it could spend it. But when the Fed took that responsibility on itself, that might be a different story. I don't know. Anyway, let's move on from that. I saw an interesting article today, and it's again one of these completely misinformed. This was on marketwatch.com, where the author tried to explain what was going to happen as a result of, QT, quantitative tightening. So the author first went into quantitative easing. What happens when the Fed buys securities? And the author said, this is the standard line, that the Fed adds money into the system. And he said under ideal conditions, first he said it adds money into the system, that increases bank reserves. And then he said under ideal conditions, those reserves are lent out to businesses and households. And that is just completely wrong. You see, when I read something or when I hear somebody say something, if they have the understanding wrong, then I just completely discount what they're saying. I mean, you have to have the correct understanding. Banks don't lend their reserves other than to each other overnight for, a few basis points. And they just, even if they wanted to lend their reserves, it's just like if my bank lent its reserves to you as a loan, there's no net increase in reserves. Their reserve balance gets debited, and another bank, their balance gets credited. So it just stays static. Those reserves just stay in the banking system, and like I said yesterday, excess reserves, those being reserves above required reserves, they just sit there. And so, but yet, what I'm trying to say here is that wrong understanding that is pervasive. I mean, if you read an article like this one, or if you hear people talk, and it's almost excusable if it's some, financial writer or journalist, but I mean, you still hear this among central bankers. I mean, this has been a thing now for a long time. I mean, you hear it from the ECB, you hear it from the Bank of Japan. I mean, lending out that they're going to make more loans because we increased reserves. They literally can't, because of the fact that reserve assets, they require capital to, back those assets. And I mean, I'm not going to go over it again because I've been over it so many times. But anyway, in the article, in the post, then they went on to explain quantitative tightening. And of course, that was wrong too. I mean, tightening is like they're going to be draining money. It's just a recomposition of the financial assets in the economy. I spoke about this yesterday. You're going to have more treasuries and agencies and MBS owned by the banks as opposed to reserves. Those instruments earn higher rates of return. The treasury pays interest on those things. So that's a net flow of income into the economy. So there you have it. I mean, this is just, you see this everywhere. It's a false understanding, but by the same token, when a lot of people believe this, it impacts their behavior. It affects their behavior. I mean, if the belief is that this is a drain on, the money supply, so to speak, people will behave in a certain way, and you're seeing that happen. I mean, there's a very clear defensive posture now. You could see it in the commentary. You could see it in all the dire predictions about recession. So it's out there. And by the way, this week's AAII Weekly Sentiment Survey, I took a look at it today. I was like a day late on that, but I was shocked because, not so shocked, but bearish sentiment increased by it was the biggest 1 week increase in bearish sentiment in 30 months, almost 3 years, all right? The biggest single week increase in bearish sentiment among individual investors with respect to the stock market in 30 months. So you have bullish sentiment like way below the historical average. You have bearish sentiment way above the historical average. And what was interesting is that the previous week you had a very high level of neutrals. I think I spoke about that in a video I made last week. The neutrals jumped off the fence to the bearish camp this week. Now the survey was through Wednesday. In other words, through the week ended April 6th. Biggest 1 week increase in bearish sentiment in 30 months. If you're going to be a contrarian investor, and again, this thing is not necessarily a perfect timing device. I mean, we saw, for example, when the market was hitting high after high after high last year, I mean, the bullish sentiment stayed elevated for a while. It wasn't like at extreme elevation levels, but it was high. So I'm not saying this is a perfect timing indicator, but if you're a contrarian investor, if you like to look at things from a contrarian perspective, in other words, when everybody's bullish, you might be a little bit cautious, or when everybody's bearish, you might be a little bit more aggressive. I mean, this is a really good signal. I mean, you have this very high level of bearish sentiment, and it's not just reflected in this one survey. I mean, as I said, just read the headlines out there, read the commentary, or read these articles that I'm referring to and how people characterize Fed policy. I've said many times that monetarism is a mental illness. It's a kind of a psychosis. The financial markets are so myopically focused on monetary policy. I mean, globally, that's all anyone ever talks about. At the highest level of finance, it's always about central banks and the Fed and monetary operations, and they do not understand it. They completely do not. There's a it's kind of a dogma, you know. It's kind of like it's an opinion-based thing that's put out there as if it is fact. Like when the Fed does QE, that's printing money, they're printing money. There's never a discussion or an explanation of how that's just a recomposition of financial assets. That's all it is. So I'm not surprised when you see behavior that correlates to the way people think about something. I mean, that's just human nature. That's natural. You can't expect, you know, everybody to delve into this and to try to really, you know, understand it. It's much more convenient to accept, you know, the mainstream explanation because it's purportedly coming from experts, okay? And people will just rely on that. It makes sense to them. I mean, they've heard it so many times, like the central bank, it prints money. It's a bank, you know. Again, I mean, it's just when you read this thing, if you understand it, the misinformation, the lack of understanding in these so-called explanations, I mean, at a certain level, it becomes kind of comical. But anyway, that is the rundown. I think we'll probably stay in this, you know, kind of choppy market bias until we get that Fed meeting on May 8th. I think extreme bearish sentiment right now, and the fact that so much of monetary policy going forward, at least what the Fed is telegraphing, is already built into the market. And so with that in mind, I think you got to be buying these dips. You got to be accumulating a position because I think the pain trade, like I had a friend who was an S&P, he was a great S&P trader. And I asked him one time, it was a long time ago, I said, how are you so good? And he said to me, Mike, I try to think about what market move is going to hurt the most people. And that's what I do. And I think right now, the market move that would hurt the most people financially is if we took off higher. Yeah, I could be wrong, but I mean, that's my position right now. Anyway, it's Friday. Go out, enjoy everybody, and I'll see you tomorrow. Bye.